Welcome to the next episode of the Understanding Crypto series. Today, we're going to take a look at the President's Working Group on Financial Markets, which created a report on stablecoins. The President's Working Group worked closely with the FDIC, Federal Deposit Insurance Corporation, which insures banks, as well as the Office of the Comptroller of Currency. So let's take a look at what they came up with. This report was released in November 2021, and it's a really important report from perspective of giving the US's administration's perspective on where to go with stablecoin regulation. So the report includes an executive summary. They set out the background of what's going on currently with stablecoins. Stablecoins are growing rapidly. There's over $140 billion currently stored in stablecoins. And so they're going to talk about the use of stablecoins both from a making payments using stablecoins perspective, as well as the use of stablecoins in decentralized finance or DeFi. In fact, something like 40 to 50% of stablecoins are being used in DeFi, depending on the stablecoin. Some of the stablecoins have even higher percentages. Then they're going to talk after setting out the background and what's going on today with stablecoins. Then they'll dive into the risks and the regulatory gaps. Risks to stablecoin users and stablecoin runs. They'll talk about the fact that, some stablecoins don't have a lot of support. And so what happens if things go wrong? Recently Tether got fined for not having adequate support for their stablecoin, in fact, lying about their support system. So they'll talk about some of these risks and regulatory gaps. Risks to the stablecoin users, payment system risks, potential for systemic risk, concentration of economic power, and so on. And then they provide some recommendations, both for legislation as well as interim measures. And the reason why they provide both is because the legislation process is relatively long. And it takes a long time for legislation to go into place. So they want to give you some recommendations for what the administration focus on until and at which point they actually have legislation. And then they talk a little bit about some of the illicit financing risks involved with stablecoins, and then they talk about some international standards. And then they provide a list of the participants to which they reached out to in coming up with this report. So let's take a dive into the report a little bit detail. I'm not going to go through the entire report word by word, but I will kind of show you some of the highlights of the report just to get kind of a feel for what the report is diving into. So, here's the executive summary. Basically, the stable coins are growing fast. They're a very innovative and entrepreneurial approach to payments, and a potentially a disruptive technology that can really change things. And they're being used heavily in this new DeFi area. But there are some risks. Anytime we talk about cryptocurrency risks, there's risks like money laundering, fraud, and so on. And really, the regulators are coming at this from the perspective of how do they protect the consumer retail investor. How do they protect the small person, not the super sophisticated investigator, but someone who just puts the money into a cryptocurrency? How do they ensure that that person doesn't lose everything? So those are the sort of perspectives that the regulators are taking. And so they kind of go through and they lay out the various risks that stablecoins could potentially offer in their executive, and then they give some recommendations for what can be done. So that was the executive overview. So then the next few pages dive into explaining what stablecoins are. Stablecoins are this idea that you're gonna have a cryptocurrency that's not gonna be volatile. If you say the cryptocurrency is worth $1, it stays worth relatively $1, as opposed to, say, for example, Bitcoin, which can go up rapidly or can go down rapidly in terms of its value. But stable coins are still a cryptocurrency, which means they have all the benefits and disadvantages of transferring cryptocurrency, using wallets and wallet providers and so on. And then here we've got, a brief explanation in here about how stable coins work, by, how the stable coins value is governed, what sort of reserve assets back the stable coin to ensure that it stays roughly the same value, and who has custody of the reserve assets. And then how the digital assets transferred and distributed and so on. So here we can see a chart on the use of stablecoins over time. You look back at January 18, January 19, all the way to about July of 20, there was very little investment in stablecoins. All of a sudden, you look at 1 year later, July 21, we're up over 50 billion. Actually over 100 billion. Where January 21 was 50 billion, July 21 is over 100 billion, and it's continuing to grow. So there's been a tremendous growth in stablecoins in 2021 compared to all the growth in the previous years. Now, stable coins are predominantly used in the United States for trading, lending, and borrowing of other digital assets, with DeFi platforms. And so the report goes in and spends a couple pages describing how it works from DeFi perspective. And in the US, there's actually multiple regulatory agencies. We don't have a cryptocurrency regulatory agency. Instead, we have a bunch of different regulatory agencies that could potentially be involved depending on the type of asset it is. So, for example, the SEC, the Securities Exchange Commission, regulates equities. The CFTC, the Commodities Future Trading Commission, regulates commodities. So depending on whether you view the stablecoin as a commodity or an equity, could determine which regulatory agency would have the ability to regulate it. So, one of the reasons why DeFi focused on stable coins is because it gives them the ability to quickly identify the value of the assets and move that value using cryptocurrency as opposed to using another commodity to represent the money that's being moved. Furthermore, stable coins, have a lot of efficient aspects for moving money overseas relatively quickly. I'm not going to go through all this information on DeFi. I'm going to have other lectures on DeFi. But basically, they talk about the fact that Ethereum currently is a predominant blockchain for DeFi protocols. But there's a number of different stable coins that are used on those DeFi platforms, including USDC, USDT, DAI, and others. Here's a percentage of stablecoin supplies locked in Ethereum smart contracts. USDT about 20%, USDC 43%, and DAI 58%, it looks like, as of October 20, 2021. So again, you can see, and over time, you can see each of those increased over the last year. And of course, there's going to be risks. There's risks of fraud, misappropriation, people stealing, hackers stealing information, money, conflicts of interest. It's quite possible that someone who's providing the stable coin is also providing other products, and this is a conflict of interest. There can be a lot of different potential risks. And so the regulators might be concerned about these risks. I mentioned earlier that different regulators, different authority. I'm not going to go into that in detail right at the moment. I'll cover that in a different regulation. Now, one of the big worries is this loss of value. What if the stable coin isn't really worth $1? And then when people go to redeem it, they can't get the money they put in, and therefore, you could have a run on the market. And so that's one of the things regulators are concerned about, and one of the risks that they're concerned about handling. There's other risks like operational risks, liquidity risks, and so on. We'll talk about liquidity in another lecture, how DeFi handles liquidity. It's actually a really interesting concept, and we'll spend a fair amount of time on it. And then there's risks of scale. Stable coins were relatively small up until about a year ago, and they're growing rapidly, and they may continue to grow rapidly. And so a part of scaling so rapidly is, some things that might originally have looked like small risks can become a lot larger when you're a lot bigger. There may be some regulatory gaps where things aren't being regulated. And so this presidential working group, in combination with the FDIC, and the Comptroller of Currency, came up with some recommendations. The recommendations really came down to two sets of recommendations. One set of recommendations for the current regulators that they should be focused on right now, as well as another recommendation for Congress in terms of what Congress should do from a legislative perspective. So let's talk about the legislative perspective first. So the president's working group recommends that Congress should pass some legislation to handle some of these risks we talked about, especially for the payment stablecoin arrangements, as well as the use of stablecoins in DeFi. And so it kind of goes through here and describes, what they could do, but basically looking at protecting users, the people who have invested their money in stablecoins, from the possibility of giving them consumer protection and avoiding a run on the assets. Well, one recommendation they make is they require that stablecoin issuers be insured depository institutions, which are subject to regulation at the depository institution and the holding company level. What does that mean? That means they want these stablecoin issuers to be banks insured by the FDIC. Currently, none of the stablecoin issuers are banks regulated by the FDIC. So all of them would have to go through multiple hoops to do this. It'd be expensive. The regulations might not be approved for multiple years. It'd be a long, expensive process. It's not clear whether or not Congress would actually pass this legislation. Congress is relatively slow to act in most cases. So it could be 10 years or more before legislation gets passed. And it's not clear that at the end of that process, Congress would decide that the president's working group was correct, that these assets should be regulated by the FDIC. But this is the recommendation that the working group made, is that stablecoins should be looked at as almost like the services provided by a bank and should be regulated the same way a bank regulates its services. They also want to require stablecoin issuers to comply with activities restrictions that limit affiliation with commercial entities. Again, the way a bank might be somewhat limited in its affiliation with commercial entities, they want to limit the stablecoin issuers limit affiliation with commercial entities. And they also want to perhaps put some limits on the use of user transaction data by the custodial wallet providers, entities like Coinbase and so on. So it's some interesting recommendations. Congress may or may not ever act on these recommendations. But then we get into interim measures. What should the agencies who have some regulatory power do? And so, there's recommendations that, the various authorities who have regulatory power over securities, commodities, and derivatives should pay attention to what's going on in the stablecoins process and, use their powers to regulate these stablecoins when necessary. And they also recommend that a council consider steps available, from a financial management perspective and regulation perspective as to what should be done. And they give a little comment about illicit finance risk mitigation, the fact that illicit actors like terrorists and other criminals might be using stable coins for moving money across borders and trying to avoid traditional regulations to prevent criminals and money launderers from moving money across borders. And so, they talk a bit about their recommendations for international implementation of a variety of anti-money laundering standards in this part of the report. All right, and then they talk about what's going on from an international standards body approach and the fact that these agencies want to work with, overseas countries on how stable coins can be regulated. Because again, if you think about it from a cryptocurrency perspective, these cryptocurrencies really are viewed as a global phenomenon. They're being used across the world in a lot of different venues for a lot of different reasons. And so one country's regulation is not going to be sufficient to truly regulate these things. It would have to be an international approach with multiple countries working together across jurisdictions. So this has been just a short little video taking a look at the November 2021 report on stablecoins that was developed by the President's Working Group on Financial Markets, the Federal Deposit Insurance Corporation, the FDIC, and the Office of the Comptroller of the Currency of the U.S. Again, this is a recommendation. It is not law yet. For anything to become a law in the U.S., it would have to be passed by Congress and then implemented by the relevant agencies, which is a very long process. But this is a report on what the president's administration believes may be the path forward on stablecoin regulation in the US. Thanks again for watching Understanding Crypto, and tune in next time. We'll dive in deeper into crypto technology.